Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 295 for March 29th, 2021. This is going to be a special Option Professor Market Outlook episode. If you like today's show, we're going to be doing this, or we have been doing this, but this is going to be the last Monday of every month. Will be a dedicated solo Option Professor episode. So he's going to start in a minute and share his ideas about the market, and you should be seeing his screen right now. My name is David Kosmeter. I'm the creator of TimingResearch.com, and I'm going to go ahead and turn it over to the Option Professor.
Okay, thank you, David, and welcome everybody. Good to have you with us. We're going to go over a lot of information. Quick background on myself. I'm a graduate of Boston College. I've got decades of experience in the investment area, and I've instructed thousands and thousands of people on the uses and the risks of options over my career. So basically, I think I'm qualified to explain things to you, and we'll give you our opinions and our observations, and that is for informational purposes only. So let's get started on the S&P 500. Generally on the stock market, obviously, we've got a big GDP number coming. We've got great earnings coming, and these are no secrets. And we've got a reopening coming. So what we have to be just a little careful of now, as we're at about 4,000 on the S&P, is how much of that has been discounted, right? As you saw on Friday, you had a big move of 65 points on the S&P, but then today it opens down 15 or 20. So now it's back up again. So it's, we just have to keep things in perspective a little bit so that we don't get leaning off the rails a little too far. Clearly, this is a 20-year graph, and there's moving averages and RSI right there for you. So let me explain what you're looking at. You're looking at a 20-year graph where the long-term averages come in, and you can see them there at 30.56, 32.09, and 34.44. Now we're trading almost 4,000. So you're almost 600 points above the 1 year. You're 800 points above the 2 year, and you're almost 1,000 points above the 3 year. By any stretch of the imagination, and this thing goes back to 2002, wouldn't you say we're a little bit extended here? You'd have to say that, right? Now, of course, you have very unique situations going on because of the stimulus, and you've got it, interest rates are supposed to be low for 3 years. So obviously, that is very much positive for the market. The jobless claims are tanking because people are going back to work. And when they open the service sector, it'll really drop even further, which is what we've been saying for a long time. And you've got the banks able to buy back their own stock again, June 30th. And so you got a lot of situations going on here. Money supply is up 4 times in the last 20 years, 5 trillion to over 20 trillion. So there's a lot of money out there. And personal income and household savings are very strong at a record pace. So you've got a lot of things that are obviously pushing the markets higher. But as you can see, they have already gone quite a bit higher. And sometimes you can get corrections, right? And so that's basically what we're trying to keep an eye out for. There was a huge rotation from growth to value, because when the interest rates start going up, that's favorable for cyclicals, favorable for value, but not so good for companies that you're discounting future earnings on, because the interest rate factor in that valuation has changed. And that's why you've had a tough time in things like QQQ and Apple and all the turnout stocks like Teladoc and companies like that. As a matter of fact, some of those companies, as I said in the newsletter this week, are off quite a bit. Snowflake off their highs 50%, Teladoc 29%, Zoom 46%. I mean, if you're holding on to Zoom and half your money's gone out the window from the highs, you're not that happy about that. Roku minus 35, and then Shopify, Spotify 20 to 35%, even Apple 17%, Amazon 14%. So there definitely has been a pullback in stuff that have to do with valuations. And again, the interest rates are like gravity. When they're at zero, there's no gravity, so things can fly, right? But as they get higher, then the gravity starts becoming more of a factor, and things that have flown very high start coming a little closer back to earth. So anyway, there's your S&P. And then I'm going to show you shorter term ones, like the 1 year. And as you can see, if we were to break underneath this number here, which is 3850 on the S&P, I would be very concerned. Okay. And even breaking under 3,900 now would not be the greatest thing in the world. Today's low, I think, is around 3,940. So this is a good time to keep an eye on it, because I think if you look at the RSI, it is not making big new highs here. The RSI on the 1 year is at, where are we at? The RSI is at 58. Now, above 50, you've got a bull market, and you can see that right here. This thing has been above 50 pretty much outside of what? Right here, it went down a little bit through the correction. But again, that's last here. Yeah, that's in last November when we had a pullback. Since we broke out above 3,500 on the S&P, that RSI has been pretty steady above 50 the whole way. And following the blue line and following the RSI has been the way to go. But you're not that far above the 50 number, and you are in a double high area right there. And you have not a real huge confirmation of that right now. So again, you don't want to step in front of a buzzsaw, but if you do start seeing breaking under 3,900 and then 3,850, it could start rolling pretty good. As a matter of fact, sometimes the biggest moves happen when you make a high, you come down, you try to take out the high, and if you fail to do it and you take out that point there, sometimes you can get some pretty good acceleration to the downside. So again, too early to call that, but to not have it on your radar, I think would be very silly. All right, now let's talk about the shorter term one that you're looking at here. And here, you've turned back up on the 1 month. So that's why it's pretty constructive right now. You saw it come back down today again to 39.40 and hold. All the averages come in around 39.20. So you can see what I'm saying. If you get underneath the 39.20, 3900 area, and then 38.60 down here, that would change the music quite a bit. So it has not happened yet. But if it starts happening, you don't want to just have a stupid look on your face and not have any plan of action. A 6 month situation, again, really does bring that 38.50 into play. And again, the 3,900 is a lot of action there. So that's why I say 3,900, 38.50 would be the time to obviously at least be cautious that we could see more of a drop. Again, right now it's holding and it's looking like it wants to go higher. So that's the way you go. Let's turn towards the QQQs. Which many people use as a proxy for tech, right? And I'll also go into the semis. And I'll explain something you can do for hedging in a minute as well. So here you got a different story. If you go back to the 20-year on the Qs, you will notice that it is very, very, very extended, and you have a high point there surrounded by lower points. So you actually have a price to defend against if you want to be negative on the Qs, and that point is 340. Okay, and the longer it stays under 340, again, the more possible that you're going to see more of a pullback. And again, on a long-term graph, 280 and 240 and 220 seem to be the three numbers. Now, if you pull it in a little closer to the 1-year graph, again, you got some resistance there at 320. And it's pretty pronounced. So as long as it's under 320, you have to be concerned. But you do have a situation where you have the 1, 2, 3 formation setting up, and that's where you have a low here, right? And then you pop up here and create a point, which is around 325. And then you pull back here to about 309. You don't take out this low. And if you take out 325, then the door is open for the thing to start accelerating to the upside again. RSI on the daily on that 1 year is right around that 50 number. And we know that above 50 is a good thing and under 50 is not so good. So again, if you want to get long on the Qs, I would say that a close above 320 and 325 would be your buy signal. Up until that point, you have to be somewhat concerned that this blue line rolling over could be an indication of a trend change. But again, there's a lot of people that I listen to who have said that this low here on the Qs could be the low for the year. If that's the case, we will bust out above 320, 325, and don't fight the tape. Because again, this stuff has already had a correction, right? And not a huge one, but a lot bigger than, and you can see why it would have stopped where it stopped, because you see all these high actions right around 300. right around 300. So it was a great reason for it to stop there. Now, again, the pullback should not take that out. And if it takes out the other side, that can be a pretty decent buy signal. So keep your powder dry a little bit. And again, if you want to be early to the party, I guess you could use this point here, which is 309 as a get out point, and start doing a little bit of dollar cost averaging into it under the assumption that you think it will break under above 320. And basically that's what the Qs look like right now. And if interest rates are not going to keep going up, and of course they have stalled out at that 175 mark, if they're not going to keep going up, that would be better for this stuff, because again, one of the reasons that the Qs and the tech stocks have pulled back was the big run in the interest rate going back up, the yields rising. That yield rising has taken a timeout. If that timeout is more extended than we think, then there could be a good chance that this thing rallies through the numbers and gets going. Let's talk about SMH, which is the semiconductor. And that's where your alpha can come from, if things get cooking again. Okay, it's pretty much the same story, right? Again, a lot of people think this is the bottom for the year, right there. Okay, if that's true, then we shouldn't take this out, which is around 225. And if we start taking out this 240 area, 245 area, then it's definitely back on the bicycle. So, and where's your RSI on this thing? Let's take a look. Yeah, your RSI is hanging around 50. So if you start taking out 240, 245, and the RSI starts pointing up above 50, that would lend credence to the fact that we're gonna get going again. And again, the semiconductor business, they have chip shortages, and the demand for electronics and computers and all the rest of it, and AI and everything else, things like NVIDIA, Taiwan Semi, Advanced Micro Devices, these are good companies that are going to make a lot of money if this thing keeps going, and it looks like it wants to. So bottom line is if we take out this number here, school lets out. If we can't get above this, if we get underneath 230, that would be your first warning sign. Underneath 225, second warning sign. And underneath there, then you could fall into the abyss, because if you look again at the long-term graph, this stuff is in rarefied air. And just like the QQQ at 340, you've got a high point at 260. And the longer it stays underneath there, and as the interest rates pick up or the chip shortage gets resolved, there is some gravity to this stuff. So again, you have to be a little bit careful of that. But that formation there on the Qs and the semis here is a high surrounded by lower highs, and you have to respect that. Now, again, if you're into this stuff and you want to try to hedge yourself against market declines, like once this thing hit 260 and started to fail, there's a few things you could have done, especially if you've been in there since 120 or if you've been in there in the last year, even since, last summer, you're in there at 160, the darn thing goes up to 260. That's a pretty big run, right? So once you see a high surrounded by lower highs, maybe you want to take a little bit of a position of where you hedge yourself. So here's some examples. One thing would just be doing simple covered calls. When you get a market that goes up like this and you think it's stalled out and you're at 260, you can sell a at the money call at 260, an out of the money call at 270, or an in the money call at 250. Now, obviously, you're agreeing to sell your stock at that price until the expiration date. So whatever month you choose. And again, if you're writing options, generally people try to go 3 months and in, because that is going to be the teeth of time decay, called the Black-Scholes model. So 3 months and in are generally where the sellers reside. And for those who are not just doing abject gambling and are trying to do positions with options, buying them 9 months and further out is the better way to go if you're trying to take a position, because that's where time decay will be less of a factor. Using common sense as your guide and the Black-Scholes model, as options come closer to expiration, they've got to lose their time value, and then they're only worth their intrinsic at some point. The further out you go, people are not going to be panicking that they're running out of time. Ergo, the time premium should not compress as much as it does on the front month. Pretty common sense when you think about it. So anyway, if you sell an out of the money call, you're going to get less premium, but then you've got what? You've got the upside from the 260 up to 270 before you have the possibility of being called away. but that premium gives you less downside protection. The second of 260 at the money is going to give you a greater premium than the 270. But again, you're agreeing to sell it at 260 plus the premium. And so again, since you're fairly close at that point, you have a better chance of getting called away. The third thing is you're selling in the money one, which is going to have a fatter premium because it's in the money. It has intrinsic value. Plus it's got a time premium. So you're going to get a good premium there. And then if it gets under 250 and stays there like it's been doing, you can collect the premium and you can keep the stock, which is really the good thing. Now, if the market starts moving against you, starts going up, well, you can either just sit there and let it get called away, or you can do something with the short call that you took. And some people call that either buying it back and taking a loss on it if you have one, and then you have nothing encumbering your stock. Or you could roll the position up. And let's just say you sold the 260 and it goes down here to 230, but then it starts going back to 260 and you go, you know what? I don't want that on anymore. So you buy back the 260 call and call it a day, plus or minus whatever you sold it for, or you roll it up and you buy back the 260 and maybe you sell the 270 call at that point to give yourself a little bit more upside of 10 points before you'd be at a risk to getting called away. So that's called rolling up your position or adjusting your position. Conversely, if you sold the 260 or sold the 270 calls at that point, and now the market's rallied back up to 240, but you don't think it's going to 260, you could buy back your 270 call, more likely at a profit, and then you can sell a 260 call. And that's called pressing your call down. And that, of course, reduces your ceiling from 270 to 260, but it brings more premium into the account. Okay, so anyway, that's one way of doing it, called covered call writing, right? Another thing you could do up here is trim. What does trim mean? Well, say you had 1,000 shares at 160, and now you've got the thing at 260. Well, you got a pretty big gain there. Maybe you take 200 shares off and keep 800 and do a little trimming. And then if it pulls back like it did, put your other 200 back on. So you can trade a little bit out of it. That's called trimming, and that's something to do if you're at a high point, possibly. The next thing that is possible to do is called a collar strategy. Now, on a collar strategy, the semis have run up to 260, and you go sell the 270 call, or you sell the 260 call, whatever you sell, and you take the premium, and then you buy a put. So say you sold the 260 calls and you bought the 250 puts. And say for the sake of argument, the premiums were the same. Well, that means you have the obligation to sell at 260, whatever shares, every 100 shares is one contract. So as many contracts, that's what you are obligated to sell at 260 if the people want to call you away. And then the 250 put gives you the right to sell at 250. So your principal is protected at 250, but that put until they expire. Now you've traveled down to 220. So you could have made $30 on that put down here, and you could have maybe taken your hedge off at that point and pocketed $30 and then let it go back up. Or if you're still in there, you're still up $12 of intrinsic value, depending upon, and again, if the 260 paid for the 250, your cost basis net is zero. So you're in pretty good shape. So a collar strategy is where you sell the call and buy the put. And again, that can be a very effective way of creating insurance on your positions, meaning some kind of floor on your equity, but using the call money from the buyer of the out of the money call to pay for it. Because one thing that can be problems when you buy married puts is it can get expensive if you keep buying puts that go to zero. That obviously is going to chip away at your principal. Let's see what else you could do. You could do a replacement trade. What's a replacement trade? Again, you bought this thing at 160 back in the summer. It goes up to 260. You're up $100. You get out. You take $100 gain. And what do? You replace it with call options at 260, say for $10. Now you've got the right to buy at 260, and you got $10 at risk. If it's going to keep going at 280, 290, 300, or whatever, you got a position. If it comes back down, those options expire when they expire at 260. So you'd lose the $10, but the other $90 you took off the table, you can reemploy on a dip. So that's called a replacement trade using calls, or you can do call spreads where you buy a 260 call and sell the 270 call. And maybe you buy this for 10 and you sell the other one for 4 and or 5. Let's say you sell it at 5. So now you only got $5 of risk out there. But you only have a potential of making 5 because you can only make the difference between 270 and 260. So replacement trades are another way to go. Married puts is a way to go. Trimming is a way to go. And the covered call writing would be the way to go. And clearly people who own Snowflake down 50% or Teladoc down 30% or Zoom down 46% would be well served had they known that strategy and employed it at some point. No doubt about that. Even the guys who own Apple at 145 would be in better shape today had they done the strategy when it was in the 145 area. So these strategies we talk about in the newsletter, and we also talk about it on the monthly subscription. Our monthly subscription is very reasonable. I'll get to that at the end of the broadcast, but every week, and you also have an ability to ask the option professor. So if you have a situation you want to ask a question on, you can either post it on the blog, or you could email us and let us know the question you have. And if we can give you help with the answer, we certainly would. So a couple of good reasons to be a subscriber is you get that feature of Ask the Option Professor. And again, we've done this for a very long time, so we certainly have a certain amount of knowledge on some of the alternatives that are out there for you. Okay, so that gives you a little bit of an idea of the S&P, the NASDAQ, and the semiconductors. Now, again, what I wanted to do here today is go through a little bit of a around the world on some of the things that we've been looking at and what they look like on a 3-month basis. Because, we're done the first quarter. So how things have been going is a big factor, right? So as you can see, we started the year here on the SMH at around 215 and it's trading at 239. So for the year, it's doing okay. Let's take a look at a few other ones. The gold market. Well, we'll get into that a little later. Let's go into the S&P. Okay, on the S&P. We started the year in the 3,700 area ballpark, and we're up at 3,900. So obviously it's had a very good time, and you probably already knew that. So let me show you things you probably don't know. The price of gold. A lot of people have been very bullish on gold. People who've read my newsletter, have been hearing that the gold is in a corrective stage, and there's no real upswing to it like we saw last year for a while. And as you can see, it started the year at 1980, and we're down here. So people who've been buying gold and owning gold, they can't be too happy with that. Now, I'm not saying gold's not going to have a run at some point, but right now and in the last 90 days has certainly not been the time to be buying into this thing. Now, again, we did think there would be a bounce out of this area here, and we got one, right? You see there, 1675. In fact, in the collective 2 account, which you have an ability to find out about when you're a subscriber, when it dropped down to 1675, we took positions, and when it rallied up towards 1740, we blew them out. And so bottom line is we took advantage of that bounce. This here, 1675, is a very important number because it is about a 38% drop from the low of 1040 where gold bottomed and the high of 2065 where gold peaked. A 38% drop is around 1675. That was the reason we took our shot down here, and that's the reason we obviously did pretty well. But as I said in the newsletter, the easy lifting is done. We need to get above 1750, 1760, and you can see why. And then on a longer term basis, 1850 and then 1950 to really get back on the bicycle. So we're monitoring the gold, but again, we think it might be a little early so far unless we start seeing these levels break. Otherwise, we're thinking late summer, early fall would be the time to hit the gold and hit it hard. Okay, and of course, on the subscribers, we keep you informed on how we're seeing and what we're doing on that as well. All right, so there's your gold, and then silver, same story pretty much, but I'll put it up there so you can at least take a look. And for the year, Silver is up in the 28 area, and now it's at 24 and change. So again, the metals have not been the place to be because again, the dollar has picked up strength and the inflation that they keep talking about is really not there. And people have gone to Bitcoin if they want to speculate on a hedge or store of value. So there's been a number of reasons. And of course, the interest rates going back up because real yields are still low. In fact, they're negative, but they're higher than they were. Talking about interest rates, you wonder why people have lost money in bonds. And of course, people who have been subscribing and listening to our information have been well aware that this thing has been going in the toilet all year long. So we've been explaining to people since last March that the interest rates at 0.5% on the 10-year was the lowest you're going to see probably in anybody's lifetime. Secondly, since the beginning of the year, this thing's gone from 158 all the way down to 135. So if you've been long duration, which we have preached against for a year, you're getting whacked, and you're getting whacked very hard. Now, we have come down very far, very fast, and that's why you're stabilizing down here. And that's why the NASDAQ and the QQQs and the SMHs may do okay if that low holds up. And if we actually get a little bit of a rally, because if stocks do have a correction, these things may rally. And if they rally, I would think that might not be so bad for the tech sector, because again, the rates calling the dogs off would be very good for the tech sector. But the bottom line is, even if we got a rally, just like in the gold, a dollar, we're getting a rally in the dollar. I'll show you what that looks like. And we're getting a rally in the bond market. But again, the fundamental problems are going nowhere. And so let me just get this going. Dollar index. So again, the fundamentals of a lower dollar are still there, okay? The fundamentals of a lower dollar are still there. And the fundamentals for higher interest rates are still there, because let's use our common sense. The GDP is rallying. The prices are firming up on inflation. The money supply has exploded, which means money is all around the place. You are looking at a situation where the debt for corporations, junk bonds, keep hitting record levels, and corporate bonds are hitting record levels, and now the international guys are jumping in. So you've got nothing but debt being printed out, and a lot of it's being done at extremely low rates. Then you've got the federal deficits and the trade deficits and all these fiscal stimulus packages, and they have to be paid with borrowed money, which means the government is going to be issuing tremendous amounts of debt. And if the people that are losing money in bonds want to get out, meaning they're sellers, and the Treasury is sellers, then the only guy left to buy, if the buying is not there, would be who? The Fed. And that's monetization. And that's when the gold could get back on the bicycle later in the year, as these deficits have to be funded. And if these interest rates keep rising, because of, you'll hear retail sales are going through the roof. You're going to see jobs job reports are very positive, and these are all, and the GDP, they're admitting it's going to be 6%, but you know it's probably going to be 7 or 8. And those kind of GDP numbers does not lend itself to extremely low interest rates. So, and when you're running these kind of deficits and you're printing this kind of money, 5 trillion to 21 trillion, and 20% of all US dollars have been printed in the last 12 months. Well, that generally is going to be affecting the currency at some point. So again, we've been bullish on this thing. I'll go back a year so you can get an example of what we've been telling people in the newsletter. The 104 area to 100 area was the sell zone. And as you can see, in the last 6 months, last year, it's been deteriorating all the way around. But when we got down here to the 80, well, this is 84, 85, and the real dollar index that I follow, it's 88 to 90. It was overdone, way overdone. It had a 14% drop. So we were thinking that was it. And we've been thinking correctly, because it's been going up ever since. And you can see it's positive now because we have reinstituted our yield advantage. You earn more money on interest with the US than you do overseas. And that makes our currency look more attractive. Plus, we're way ahead of them on vaccinations, and we're way ahead of them on opening. And our GDPs and growth are ridiculously greater than theirs. And that's what makes our currency right now more attractive. But if you go back on the 5-year graph, I will show you that I do not believe it will go much above this. Well, in this chart here, it would be about 90 or so. On the one that I follow, it's going to be about 94 to 96. I have another graph. If you're interested, I can see if I can get that for you. At any rate, so that's the US dollar, and you can see there's made a turn. And so let's look at a couple of other things that we have been very keen on this year and see how they've done in the first 3 months of the year. Now, we were keen on them 6 months ago, so this doesn't give you the entire benefit, but we were very keen on energy, and you'll see that the ETF on energy that we focus on over at Vanguard, used to be at 52 and now it's at 68. Not a bad deal, right? Okay. The other thing we were very keen on is banks. So the financial ETF over at Vanguard, as an example, for the year. This is illustrating everything that I've been talking about in the newsletter. We started the year at 71 and now it's at 84. Not a bad place to be in the financials, as we've told people. Then we're looking at value stocks. And in the value stocks, this is the mega cap value, which are big companies. Started the year at 85. It's trading at 95. Not a bad place to be. And then we're looking at the high yield. High yield meaning not high yield, high dividend. We are looking at getting 3% or better, on this ETF. And so you're getting over 3% on your money. And the thing went from 90 to 101. So you got 10% on the move, more than 10% on the move, and you're getting 3.5% dividend. Nothing wrong with that. So again, that's some of the stuff that we've been directing people towards in the newsletter, as far as what we think, our opinion, our observation about where the best place to sit and park money is. Okay. Now, with regards to other markets out there, I'll get into some other commodities in a minute. But for those of you who are looking at getting into something where you get commodity exposure, because some people do think that the prices of overall commodities will rise over time in this environment. After 2000, they did. After 2008, they did. So that's where people are getting that from. And so there's a one-stop shop for that over at Vanguard on a mutual fund. It's the Commodity Strategic Fund, something that we've been talking about since it was at 22 and 24. And as you can see, if you go back to last year, this thing has not been a bad place to be. So again, you got it at 1920, no margin calls, no forced liquidation, and you got exposure to the commodity sector. So there you go. Boom, 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 boom. Right? Having a correction now, which is good, because obviously if you don't own it, you'd like to buy it on a dip. And of course, if you own it and you've had a good result, you may want to add on a correction as well. But this is a one-stop shop where people can get exposure to the commodity sector. And it's something that we bring to people's attention. All right. What else did I want to cover here today? All right. Let's say a couple of other strategies here. Let's look at Apple. And Apple's at 121. And it recently went down towards, where's that number here? It recently went down towards 118. Okay, it used to be 145. Now, this doesn't look very good right now. So let's be frank. But let's say you think it looks good. Well, let's say it broke above 125 and started going like 130. And say you don't want to pay that money. You'd like to do a strategy where you agree to buy Apple at a lower price. You get paid a premium, and then you take the premium and you buy a call with that money. Here's an example of that. again, this is where you have the money in your account to buy the stock. So this is not where you are doing it on margin or anything like that. You have the money in your account to buy the stock. And you say the stock right now is at 121. Okay. If you, again, in this particular setup here, it could still be dangerous because everything's still pointing down. But let's say it was looking good and these averages were under the price. Say you don't want to pay 121. Are you willing to pay 115? Yeah. Okay. You sell a put option at 115. When you sell a put, you're agreeing to buy the stock at 115 and you have the money in your account to pay for it. So that gives you a premium, meaning the put buyer, he has to pay a premium, right? For the right to sell. Well, you're going to get the premium because you're obligated to buy. So you're obligated to buy at 115 and you just got paid a premium. You take that premium at 115 and you buy the 130 calls with the premium. And let's say it's an offset, meaning this is going for the same price as the 130s. Now you have the obligation to buy at 115 and the right to buy at 130. And say you go 6 months out. Well, these offset each other as far as premium. So if it stays between the 2 points, they'll both expire at zero when they hit expiration, right? If it's under 130 and above 115, both options expire, they would be at zero, both of them. That's a wash. Because in this example, I'm saying the premiums are the same. Now, what happens if the I-12 comes out? People look at the screen and see it's way bigger than the I-11 or I-10, and they can see there's 3 cameras on the back rather than just one, and everybody loves to have cameras, and everybody loves to have a bigger screen. So all of a sudden, you mobilize the however million people own the other ones, and they start buying into that new one. And then on top of that, they come up with other products. And all of a sudden, everybody's got a lot of money as we get closer to the end of the year because they've gotten all these checks in the mail. So maybe it pops through the 125 and the 130, and it goes up towards 140 or 145. Well, you have the right to buy at 130. If it goes back to the high of 145, you got a $15 plus there. And the cost of getting that 130 was given to you because you sold the put. So the bottom line is you have intrinsic value of $15. And because you sold the put to pay for the 130, you don't have anything going on there. Now the risk is it comes down and tanks through 115. They put stock to you at 115 and you got to buy it. And then once you buy it, everything under 115 is going to cost you money. But when you get a big move down in a stock like Apple that you believe in and you think you're at a good point, selling a put and collecting a big premium to make the obligation to buy at that price and then using that premium to buy calls if it's going to go back is not a terrible strategy. Let me show you a case in point where that might have been a very good strategy here. Let's go back on the 5-year graph and see if we get any examples. Well, here's a good example right here, I guess. Last summer. Last fall, we had a big drop down from what? 140 all the way down to like 103, wasn't it? Yeah, 103. Well, say you sold the 100 puts because you didn't think this area here would get taken out. So you sell the 100 put, you got a premium. And then you bought the 110 calls and say it was a washout, meaning the put and the call went for the same price, so they offset each other. Now you're long at 110 and say you went out 6 months or 9 months. Well, this thing goes from 110 to 140. Now you got a $30 plus here. And your risk, which was to have to buy it at 100, never came to pass. So that would have been a good time to do it. On big drops, sometimes this is a way to do it, unless the big drop is going to get worse and worse. And as you can see, there's a reason why it's holding these areas here, because the 5-year long-term moving average comes in right here. So staying above the 5-year moving average, the 3-year moving average on the 5-year graph, which is around 121, is a good thing. And getting back above the next level, which is 125, which we mentioned, would be a very good thing. And then again, busting above the 127 mark would be another good thing. So if Apple can get on the bicycle, you can see why it would have stopped on its drop. And you also would see that if it starts getting above its moving averages again, just like here, got above the averages again, right? Started to look good. Or when it dropped down here, during the crash, once it got back above the average, that's your buy signal. Boom, 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 boom. But and look at your RSI right at 50. So this is at a critical point for Apple. You start blowing out 115 and this RSI goes underneath 50, then these moving averages start getting very ominous above the market, and that's a different ball game. So it's pretty much crunch time for a lot of this tech sector because they've had their corrections, and now if they're going to be more than a correction, then it's going to break out through these lows. And that's why a lot of people are saying, that the lows of this last month of March in the tech sector had better be the lows for the rest of the year if they're going to get going. And if they blow out this month's lows, then you can see that deterioration might be more significant. And then the longer term averages come into play. And the longer term averages come in on the 20-year graph at 110. And then way down here. Hard to believe it could ever drop down to 80, but things happen when they happen, right? But again, right now, keep an eye on it because it has held the 118, 120 area. And if it starts moving forward and higher, probably not a good idea to fight the tape on that one. Let's look at another one that might be a hedging potential here, or could have been. JP Morgan, big move. Yeah, big move up to 160. Now it's at 152 and change. Now, again, this is on a 20-year graph, and you can see all the supports down at 110. So it's about $42 above all those averages. Even if I pull it into the 5-year graph, it's still 120 on the long-term average. And you can see a lot of times the market goes back to the mean, go back to the mean, go back to the mean, go back to the mean. And this thing has a high surrounded by lower highs. So the bottom line is as long as it stays underneath the high point of 161, 162, the longer it stays underneath there, then maybe there's some gravity going to be going on. At any rate, if this is something you're long and you think that the market might have peaked, this would be the neighborhood where you'd investigate some of your hedging techniques. Covered call writing, collars, married puts, replacement trades, or trimming. Let's see what else is going on here that I wanted to show you. Yeah, in addition to the value that goes on in mega caps, there's also value in mid caps and small caps. And here's a couple more that I'm going to show you, and we keep the subscribers abreast on. You can see this one has been a good deal too. Once it got above 100, it was pretty much time to get in. And it has a high surrounded by lower highs as well. So you have to be a little concerned about that. But, if a pullback happened towards 120, that'd be very interesting because then it would be coming back to the highs of last year. And that might be an area of support corresponding with the 2-year average there. But again, this is one of the ones that on a long-term basis, may continue to do well because what happens with mid caps and small caps, and I'll give you an example of small caps, is sometimes the big guys buy them out. And that's why some people are saying that mergers and acquisitions this year are going to be very great because these companies are making a lot of money and they have cash. And what they're going to do with their cash is probably try to increase their business. And the best way to increase your business is to buy an existing successful business that is not very big, but has a very good plan that you think would fit into your business. And rather than you starting from scratch, you hit the boards running. So that's why acquisitions in mid cap and small cap may very well be something that happens later in the year. Here you go, though. This is another one that gave you the buy signal 115. And again, this is value, 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 value. And you can see that value, there's a graph that we can get to you, particularly subscribers, that show value versus growth. And it shows that there's been a huge, growth has gone nuts against value, right? Everybody knows that. And this chart illustrates it, but it also illustrates that there's been a turn in the graph where value is outperforming growth. And that turn looks like it is in full force, and it looks like it's got a long way to go. So that means your value, your cyclicals, your banks, your energies, et cetera, have a long runway ahead to catch up to what growth has done. And growth could be a little bit of a slower mover because of the higher interest rate environment. And that makes a lot of sense. Let me turn towards international. And these are developing markets. And from what we hear, China is way ahead of us in the foundry area, also in memory area, and also in the area of AI and robotics. And these guys work, 18-hour days over there, and they're very focused on where they're going, and they don't have the argumentative environment between Republicans and Democrats where everyone is doing something behind everyone's back or something, and there's so much paranoia, schizophrenia going on in our political structure that it could impede our ability to compete because of the divisive nature of the way politics have evolved. And they don't have that issue over there as well. Obviously, they have some uprisings here and there, but these people are not. They're focused, and they're going into Africa doing stuff, and they've created manufacturing in Africa, so their cost of production is even lower there. And they're doing all kinds of things. So the bottom line is developing markets in Asia, developing markets in Eastern Europe, developing markets in Latin America, like Brazil and Mexico. They might be something to look into because these just had a correction. And this is something that we think could be of a significant value, looking at the 5-year graph there. And, for the year, they're pretty much where they started. We started around 50 and they're at 51. So this thing, this is where I see value. I see value in the emerging markets, and I can see on the big dip here, this would be the time to, start dollar cost averaging into this thing, because that blue line's not kidding around, right? It's going straight up. And the story makes sense. You're investing into, listen, when you hear the trade deficit is enormous, that tells you that Japan, Korea, and China, and people that are sending us stuff, Brazil and Mexico, they're going to be making a lot of money. How do you know that? Because their valuations are much lower than our stocks, and their revenues must be going through the roof because their exports are going up 40% and 50% and 60%. I mean, who do you think makes that stuff at Home Depot? Who do you think makes that stuff at Lowe's? Who do you think's making that stuff at Costco and Walmart? Okay. So again, you want to have some positioning, in our opinion, into the guys that are getting all that cash, and particularly when they have drops. I'll show you a couple of other ones here. This is large cap China, and it has not done anything. In fact, it's about the same price as it started the year. Started the year at around 46. It's at 46 now. And it's in a neighborhood where, maybe that low where we just saw it go down to, let's see where we went down to. I would say take a look at that low that we just saw, which was 45, and see if that can hold, because you can see these highs come in here right around 45. So there's a reason why I would stop there. And you're not buying it up here. You'd be buying it down here. And these are the large cap China shares. And then I'll give you another one here. KWeb. And this is all the internet stuff. And there you go. It's a little bit under the line here, but that can happen. And right now that thing has a low of around 72, I think. Yeah, 71. I call it $70. So you got $70 where you'd want it to stay above. Certainly you'd like to get it back above the moving average of 77. And then the RSI, I think, has probably gotten a little bit under 50. So as you saw, look where it got last time at the low. You see the low there? What was the RSI that day? RSI let's see what that is. That is March 9th. March 9th of last year. Yeah, that RSI went down to 37. RSI right now is 44. So, it's in the neighborhood of where it could be hitting a low. And so I would monitor that very closely because you're not buying it at 105, are you? No. Okay. And then what else? There was one other one I wanted to show you. Oh, yeah, Europe. Now, a lot of people are talking about the reopening. We're supposed to be pretty much ready to go by July 4, where people should be out there doing somewhat normalized activity. Asia, supposed to be normalized. Europe, supposed to be more normalized by Labor Day. And then the developing nations are supposed to be more normalized by Christmas. So using that July 4th, Labor Day, Christmas time horizon, you can start planning ahead on how the US, Europe, and Asia, developing markets, may start going. Now, this thing, again, went buy signal here at 50. This was the high from last year and the year prior. So it's up against it here at 64. So let's see how it does. If it pulls back, maybe it has its support around 58. If it doesn't pull back and starts getting above 64, maybe you use the red number around 62 as a line in the sand. But again, this is another one which may take a little bit more time because they're still fighting the vaccine problem and a little bit of surges and that like that. But Europe and Asia are the two things that you may not own that you may want to start looking into because, again, they're not nearly as extended as the US. And they are going to benefit from the US GDP going to 7 or 8% or 6% or whatever Powell says or whatever JP Morgan says or whoever. It's going to be growing. And that means people are going to be out there buying. What the government has figured out is if we go with trickle down, that's where you give tax cuts and you hope that the companies with all that money trickle down the money to the employees. That doesn't work. Come on. Anybody who's been around the block knows what happens. They give bigger bonuses to their people and they do buybacks so that the people who own their stock make a hit. That's what happens when you do tax cuts. We just saw it. Let's not be stupid. It doesn't go to salaries. But if you do trickle up, which is where, hey, listen, we're going to run deficits anyway, because if we give them a tax cut, we're going to run a big deficit. The greatest economy in the history of the world last year was running $1.5 trillion deficit. That was before COVID. So you're going to run deficits whether you give them a tax cut or you do transfer payments. But if you do transfer payments, you stick the money right in the guy's pocket and he can go out and spend it, and then the economy grows. Not just the guys who are buying back their own stock. You get it? And that wealth gap that's ridiculous now, it can tighten up a little bit because you're putting the money right into the hands of the consumer. In fact, a caveat of we're giving you this stimulus package and you must spend it by 90 days or else the card doesn't work anymore might be the evolution of it. Anyway, that's a little soapbox stuff, but I think that's what's going on because they figured out that tax cuts never get down to the grunts, whereas if you stick the money in the grunt's pocket, he can spend it. Okay, I'm going to go over because we're getting towards the top of the hour. I'm going to go over a couple of things on the commodity overview and just give you our opinion. Obviously, we follow a lot of different stuff. Being in this thing decades and decades and decades, we certainly know how all this stuff works. Okay, the soybeans and the grains, let's give you a quick example of what's going on. They're very high priced right now, but they're high priced for a good reason. There's a lot of demand for them, and the supplies have not been that great. The bad news is that they're planting the most acreage of soybeans in the last since 2014. So that is obviously nailing the price a little bit. This price used to be like $14.50. Here's the caveat. There's a lot of people hedging up here. Farmers that maybe don't have their crop already, but they think they're going to have it. And here's what can happen. If these markets remain stable and we go into the planting season and there's weather issues like there was in Brazil, and we can get weird weather, these people that are short may not have the crop to deliver, and that could cause a squeeze. So keep an eye out for that potential. If you don't have that and there's a huge bumper crop, the moving averages on a lot of these grains are way underneath the market, so they'd probably have a drop. Crude oil, we thought is very bullish since it was at obviously negative 37 last year. And we still think it's very bullish because of the demand factor. Again, it's gone a long way fast. So we thought a correction would happen, and it did. And now we're thinking somewhere in this area it stabilizes. But later in the year, we should see another rise in the price because of the demand coming out of the reopening. And of course, fuel demand from the planes and everything else. With regards to gold, again, we don't like the gold. We haven't liked the gold since it had that blow off top. And we think that the gold may be very good later in the year. But until we see price evidence otherwise, keep your money in your pocket. And then maybe at some point, start looking into it. But we'll tell subscribers how we feel as we go along. The platinum is our dark horse, and look at it, up $6 while the gold and silver are tanking. So that's why we send out a flyer on the platinum. People are interested in it. We're getting a lot of response. And again, the platinum is at a big discount to the price of gold, right? 1,700 and 1,100. It's an industrial metal that's going to go with the auto industry, and the supplies may be kind of tight. So you could have a squeeze like you got into the copper, and you see copper went from $2 to $4. So we think there's a good future possibly in the platinum. If you have an interest in that, through subscribers, you can let us know. Price of meats have gone up. As you've been to the store, steak costs more money. Here, we love the coffee market. We've been very bullish on it since 100, 110. We're going to stay bullish on it until it gets under 100, 110. Same thing with sugar. Very bullish on it at 12.30. Ran up to over 16, 17. Now it's pulling back. We'll stay bullish as long as it stays above 13. Okay. There's your S&P going back up on the day. So everybody who shorted the open is not so happy about that. And of course, there's a good reports. They're going to lower the stage for what do you call it? For the vaccine to 30 and above. US dollar, as we told you, very strong still, 92. And then we told you the bonds stink and they're down 26. Okay, top of the hour, time to do a little bit of a sales pitch, optionprofessor.com. We've got a weekly update we send out for free, which is a newsletter, but doesn't get into any specifics, but it does give good information. And we provide that so people understand, that we have opinions that make sense. And then we also have the subscription where we get into more details, and we have the feature of Ask the Option Professor. So again, you'll hear exactly what we're doing to try to create income for people. We are, or what we think is a good opinion and an observation on how going about getting income would be a good idea. Obviously, we told people to avoid duration, which was a brilliant thing to suggest to people. Then we go over growth, which means your tech stocks, which means your value stocks, which means your international, etc. We give you all that on the newsletter. And then, of course, we go into speculation, like the commodities, like Bitcoin, etc. And we give you our opinion and observation on exactly what's going on there as well. It's $49 a month for the month-to-month people, and $297 for the year. That's peanuts. The information that we're giving out is ridiculously more valuable than that, but we've been doing it for decades, so we like to share, and that's what we do with the subscribers. So to get it on the subscriber situation, you go to optionprofessor.com, and I think David will provide a link, and you basically hit the link, and you put in your credit card information, and then you're in the queue, and then you'll be getting our updates every week on what we see is going on and different ideas that come up that we bring to your attention right away. But there's an awful lot of value there in our opinion. And again, $49 a month and $297 for the year really is extremely good value. And that's why we try to set it up like that. All right, so this is the Option Professor. That's all I've got for you today. Good luck and good trading. And David's going to take over right now, and maybe he could re-explain how you could subscribe, and hopefully we'll get a lot of subscribers out of the meeting here today, and we'll have new relationships, and hopefully we'll be able to deliver good, valuable information. David, back to you.
All right, thanks. Yeah, lots of good info today. So I posted some links in the chat, and also those will be in the archive, and And if you just go to TimingResearch.com, there's a post at the top that will become the archive as soon as I can get the recording posted. And as I mentioned at the beginning, this is going to be a regular update from the Option Professor, a solo episode at the last Monday of every month, and so be sure to mark your calendar for that. And you can also subscribe to Timing Research on YouTube or your favorite podcast app to get instant updates. So, all right, thanks again.